WeWork promised to be more than just an office space. It envisioned a global community, a movement to elevate the world's consciousness. From its founding in 2010 by Adam Neumann and Miguel McKelvey, it rapidly expanded, transforming empty buildings into vibrant, shared workspaces. This audacious vision, coupled with compelling design and a unique culture, captivated entrepreneurs and freelancers, offering flexibility and networking opportunities previously unheard of. What began as a simple co-working concept quickly spiraled into a tech-fueled real estate empire, seemingly unstoppable in its ambition. At the heart of WeWork's meteoric rise was its co-founder, Adam Neumann. A charismatic and unconventional figure, Neumann was a master storyteller, selling a vision that transcended mere real estate. He spoke of community, belonging, and even spirituality, convincing investors that WeWork wasn't just a company, but a revolution. His larger-than-life personality and boundless enthusiasm were infectious, drawing in billions from venture capitalists eager to back the next transformative disruptor. This personal magnetism became a significant driver of the company's early success and staggering valuations. WeWork's model offered an attractive alternative to traditional office leases. Businesses, from startups to large corporations, could rent flexible spaces, from single desks to entire floors, without the long-term commitments and upfront costs. Beyond the desks, members gained access to a vibrant community, amenities like free coffee and beer, and networking events. This created a powerful sense of belonging, transforming sterile offices into dynamic hubs. The promise of flexibility, coupled with a curated cultural experience, fueled explosive demand across major global cities, rapidly expanding its physical footprint. Fueled by Neumann's vision and relentless expansion, WeWork attracted unprecedented investment. SoftBank, in particular, became a crucial backer, pouring billions into the company. By early 2019, WeWork's valuation soared to an astonishing $47 billion, making it one of the world's most valuable startups. This valuation was based not on traditional real estate metrics, but on its perceived status as a tech disruptor, a space-as-a-service platform. Investors were betting on WeWork's ability to revolutionize the future of work, driven by a sky-high growth narrative rather than consistent profitability. Beneath the glittering facade, financial cracks began to show. Despite its massive valuation, WeWork was hemorrhaging cash, reporting billions in losses as it aggressively expanded. Questions arose about its true business model. Was it a tech company or simply a heavily subsidized landlord? Governance concerns also mounted, with Adam Neumann engaged in self-dealing, leasing properties he owned back to WeWork, and his unusual personal conduct causing alarm. These red flags, often overshadowed by the hype, started to signal a deeper instability within the company's foundations. In August 2019, WeWork filed its S-1 prospectus for an initial public offering. This document, intended to showcase its strength, instead exposed its deep flaws. Investors and analysts were shocked by the scale of its losses, the complex financial structures, and the numerous conflicts of interest involving Neumann. The S-1 revealed a company burning through cash at an unsustainable rate, with a convoluted governance structure that gave Neumann unprecedented control. Public scrutiny intensified, and the proposed valuation plummeted from $47 billion to as low as $10 to $15 billion, shaking investor confidence to its core. With the IPO teetering on the brink, pressure mounted on Adam Neumann. His controversial management style, extravagant lifestyle, and alleged substance abuse, combined with the company's precarious financial state, became untenable. In September 2019, under immense pressure from SoftBank and other board members, Neumann was forced to step down as CEO. Despite his dramatic exit, he negotiated a staggering exit package, including a reported $1.7 billion payout from SoftBank, an irony not lost on the struggling company's employees and investors. His departure marked the end of an era. SoftBank, already the largest investor, found itself in a deeper predicament following the failed IPO. To prevent WeWork's collapse, SoftBank initiated a bailout plan, providing a lifeline of over $6.5 billion in new financing. This deal effectively rescued WeWork from bankruptcy but also gave SoftBank an even larger ownership stake, raising its total investment to over $18.5 billion. Masayoshi Son's once celebrated investment strategy, particularly through the Vision Fund, faced intense scrutiny as the WeWork debacle cast a long shadow over his reputation. Post-Neumann, WeWork embarked on a painful restructuring process. New management focused on cost-cutting, divesting non-core businesses, and renegotiating leases. Thousands of employees were laid off, and the company pulled back from ambitious global expansion. The goal shifted from rapid growth to achieving profitability and proving the fundamental viability of its co-working model. While the company averted immediate collapse, the path forward remained challenging, attempting to shed its tech darling image and embrace the more prosaic realities of a real estate business. The WeWork saga stands as a stark warning in the venture capital world. It highlighted the dangers of prioritizing growth over profitability, the risks associated with unchecked founder control, and the sometimes fragile nature of sky-high valuations built on narrative rather than sustainable fundamentals. While the co-working concept itself remains relevant, the WeWork story serves as a cautionary tale. Even the most ambitious visions require sound business practices and rigorous governance to endure. It's a reminder that even in an era of disruption, the fundamentals of business remain paramount.